Mid-2020 correctly advised our viewers to start buying stocks amid the pandemic sell-off. He's Steve Auth of Federated Hermes. You buying today?
We're not buying today, Liz. We're waiting for, we put some money in last 2 weeks ago at that first big drop towards 5,000. We've thought we would retest. Usually you would, and that seems to be the case here. We have 5 milestones we're looking for to settle this market down. And as we start clicking away at those, which we think we will, we'll probably be buyers, add another leg in.
Okay, what's the milestone for the S&P? Because we're at 51.15 right now.
Right, so we think we ought to get somewhere around 5,000, maybe 49.50, something like that over the next week or so. It wouldn't be surprising to us.
And then you would go in. But you did buy 2 weeks ago.
Absolutely.
That first big sell-off.
We're telling our investors to be at moderate overweight equities, not at max. And we want to have enough price upside to take care of all the risks that we've got on the downside here. So we're sitting there and we're looking to add. We're recommending a combination of defense and offense, sort of a barbelled approach. So we have a big allocation to dividend-producing stocks with big diversified businesses, less impacted by the tariffs, and then financials. Some of these tech stocks are getting crushed. We think are the way you play offense here. Yeah. Some of these, like Google's down 35% or something.
So your defensive plays, Southern Company, ExxonMobil, Amgen, these are dividend payers, you say, and just broad-based companies that really tend to do well, at least under the, not even the best of circumstances, but under worse circumstances.
Yeah, I mean, their underlying businesses are pretty stable, Liz. They're not the fastest growers in the world, but they're also not going to be that affected in this. We think we're in a soft patch here for sure, going into the back half of the year.
Well, Southern Company's cheaper today by about 2.25%. I think they all are down at the moment. Your offensive names, where you would jump in, these are sort of the riskier ones. Amazon. Now, Amazon has a lot of exposure to China.
It does, and the stock's down big time, more than offset that. And we would think
it's down about 23%.
Yeah, and Amazon is going to find its way to how to manage its way through this business, through this environment. They're not, they're not sitting still waiting for things to happen. So they'll find their way through this.
And they've got AWS, which is it may as well be a Fortune 500 company in and of itself.
Yeah.
Is Trump right about Jay Powell?
I think he's right in the sense, I agree, I understand how he's frustrated with Jay Powell. We were screaming, on your show and others back in 21 that Powell was way too late. He should be hiking rates. Inflation was not transitory. He hesitated. People say it's for political reasons. My guess is he just tends to be backward looking. The institution has been very backward looking since Greenspan retired, frankly. And so that's just what we're dealing with. I tend to not listen to what Powell says. I tend to think about what Powell's going to do once the data is going to start to turn. And what we're looking at here is a significant soft patch caused by all the tariff uncertainty, employment conditions starting to soften up, inflation, a little bit of a one-off impact from the tariffs, maybe less than 1%, but partly offset by things like oil down 15%. So we think that by June, he has got the ability to cut. Inflation running closer to 2.5, he will cut because the economy's softening up. So I'm really not as frustrated as the president is. I understand his frustration, but it doesn't help to be screaming at him to cut. It just ends up, he's going to dig his heels in. They're getting into a thing. It's going to be unstable for the market. So hopefully the president's going to back off.
We see the instability right now, Dow down 1,213. So you say that Powell is rearview mirror, too rearview mirror looking. So we've got a very crowded economic calendar this week. And I'm looking at Friday. I mean, we've got a whole bunch of other things on this calendar that are stuffed in there, everything from March durable goods to the beige book, March new home sales. But Friday, we get the revised University of Michigan sentiment for April. That seems to be the one that spooked the markets over the past couple of weeks. So do you put more weight into that piece?
Well, that tends to be also a rear view looking mirror. So that's going to be awful, Liz, in February. So, yeah, I mean, I don't put much into that. I know what that's going to be.
But it's not really February, isn't it? Isn't it April?
I mean, for April. Yeah. But it's going to be rear view mirror stuff. It's a lagging indicator.
And you worried about the bond market? I mean, 10-year yield 4.40 now.
That's one of our milestones. We want to see that stabilize. We have the 10-year. We have the Fed making 6 cuts over the next 18 months. We think the 10-year belongs somewhere around 4%. If you look at it relative to where it trades normally versus bonds, and where it should trade against the long-term inflation rate. So between here and where we end up, we've got the 10-year probably around 3.5 to 4. We don't like it backing up here.
Right.
And we think that's a lot of instability around confidence in the Fed, hedge funds unwinding, et cetera. But it should stabilize one way or the other. 2 weeks ago, they backed off when it was on the tariff reciprocals because they seen the bond market backing up. I think with the bond market backing up again, I got to believe Scott Bessent is explaining to the president it doesn't help to be pounding on the Fed right here.
Steve, we've got to run, but if the econo data is rearview mirror looking, our first quarter earnings, because this week we get about 118 S&P companies, everyone from Intel to Tesla to AT&T, IBM, Verizon, Minnesota Mining and Manufacturing, Phillips 66.
Yeah, they're all rear view looking here. We're more interested in guidance,
okay.
But guidance is all being pulled because there's too much inflation. So that's why the market is having a little bit of tough time here.
Well, so we're stuck with minute by minute right here on the Claman Countdown.
Yeah,
Steve.
or just look to the future. By 26, 27, we're going to be back up with the economy and earnings. And there the market's going to, against those numbers, the market looks even attractive here.
Yeah, and maybe people will wish they had bought right now. Although you say wait till 5,000.
Yeah, well, hang in there if you've got an overweight for sure. Don't panic and sell here.
S&P is at 51.16. We'll be watching it. Steve Auth, thank you very much.
Thank you, Liz.